Hello, everyone. This is me, Guillaume Lambert, and Rosalie from the Panoptic team. This is Stop Losing, Start Trading. Title of this episode is Don't Get Liquidated Like That Hyperliquid Whale. We're creating this show to educate people about how to trade options, do it responsibly, of course, not getting liquidated, but also kind of having this be a way to expose people to the wonderful world of options, which is, again, something the Panoptic team has. Worked a long way for creating, and then we want to share this with the world. So, without further ado, everything we say here is not financial advice. We're just trading, talking about political trades. Don't follow what we're doing. The intern decides to trade every once in a while. Otherwise, this is all for entertainment. So, without further ado, anything? Yeah. How are you today, Rosalie?
Good. Yeah, I'm good. I'm just kind of, watching the market, kind of thinking about what fun new trades I might want to do now. I'm pretty bearish on ETH at the moment, unfortunately. But yeah, not much, you can do. So just hanging in there.
Everyone is hit the same way, and I think we touched on that last time too. Is that the broader markets could be Nvidia or S&P 500? It has been hit pretty hard over the past few weeks, so it's hard to fight against macro trends. Again, Bitcoin has its own narrative about like store value, and it's been even going down then, but less than the other cryptocurrencies. But it's still something that again any trader has to be prepared for. As I've been saying oftentimes, the best way to protect against these wild moves is to size appropriately. Don't put all your eggs in one basket. This is ETH price, but again, the last 3 months have been down only. It's almost uh, surprising. We're at 4,000. Again, a few months ago when we launched Panoptic, 3 months ago, and now it's half of that, 50% down in 3 months. We don't see this often. This is the bear market for sure, but it's like everything in life, you just have to be prepared and then kind of not lose your shirt. So you're a bit bearish Ethereum, but maybe more broadly, like, is there another coin that is interesting to you, or all cryptocurrencies?
Um, yeah, everything that I'm trading is kind of super vanilla at the moment. Besides like numbers or ticker Bitcoin, we are just looking at like XRP and Chainlink and
Oh, yeah, I
yeah.
didn't look about Chainlink. They were at the White House summit. I don't know if it helped. It's one of those. Yeah, it turns out they also went down 50% in 3 months. So the whole, regardless of what you do, even Uniswap, I'd say let's find Uniswap. But regardless of what you do, it's hard to fight a industry-wide downturn. This one is worse. Yeah, 60% down Uniswap. But yes, it is what it is. The cool and interesting thing about the options that you can profit on the way up, on the way down, or if it stays neutral. So this is what we're trying to see with our Panoptic, the intern account. Here I'm sharing, and let me change this. I'm sharing the current market view of the intern account. So we can spy, we're in spectator mode. We see what the intern decides to do with our advice. They are up $3. This is over the past day. So even or for the whole portfolio, but even though they are subject to these losses, they were able to position themselves and be up $3. So I put everything in cash here so you can see. So anything you want to start us with, let me start it with first, Rosalie, on the intern portfolio.
Yeah, let's take a look at the BTC ETH one.
Okay, yeah. So this is trading the ratio BTC ETH. You don't see this often. You cannot trade this on Deribit, but this is an option on ETH with BTC as the quote asset. So you're trading the ratio. And yeah, what do you see? What do you feel about this trade now?
Good. I remember last time we looked at it, I feel like it was moving the other direction. So yeah, it's making some profit and some premia. Um, moved that out of range position in range, so we're making money from that call. Um, yeah, it looks good.
Yeah, it looks good. And the premium is the interesting part. For a while, we were straddling the two options. So we buy an option and sell another one. So we pay on one side and kind of get paid on the other side. For a while, we're kind of pretty even. So the price meant that the premium was close to zero, which was fine because this is a very directional trade. You want to see this price going down or the ratio going down, which it has. But if you're wrong a little bit, you're not earning any premium. But in that case, we exited that slump, went to a price range which allowed this position to earn fees, and it's been going up since then. Additionally to the fees that did 1%, and this is 5 days ago, 1% in 5 days, we also have a 12% or 11% gain in the price action. So this is another trade that worked pretty well for us. Similar to the last one, we're bearish on the ratio, so we think BTC will hold up a bit better. And that particular trade is buying an out of range liquidity chunk, moving it in the money or in range. Maybe sometimes you want to sell to a strike which has buyers or buying activity so that you get paid more. But even then, we're kind of the only ones kind of trading. Everyone is selling, but there's not much more to gain except waiting. So great trade, great direction feeling from Rosalie. And it's 5 days open in a 30-day-ish window. So we just have to wait for either the price to go way down that we're in this flat zone, or if it goes back up, we can hope that we are kind of offsetting the break even. But again, if the directionality is bearish, it's been moving this way. Good trade, nothing more to do. Now there's Brad BTC, but also ticker Bitcoin. And this one I like too because it's a meme coin trade. Anyone can trade any token they want. And again, this is one position we've opened a few days ago. How many? Yeah, 20 days ago. So yes, in that case, can you tell me about, oh, there's some price. What do you see? What do you feel about this position, Rosalie?
Yeah, I feel good about this position. It was for a really long time the price didn't move at all, but we were still, collecting fees off of that. But now it's looking like it kind of is getting close to hitting the max. Well, I mean, it can always, bounce back and forth, but I think because it's been a while, it might be a good time to close this position and open a new one since ETH has shifted. Maybe we want to choose a different range for the next one, but yeah, overall looks good.
Yeah, so this is again, we probably opened this open 20 days ago, but it stayed in range for a long time, and it's only recently that we've seen this drop. And normally, this is a delta neutral trade. This is a straddle. You want to see the pricing in range. Now it did move, so it's still in range. So we're collecting fees. The key point is that because we've been in range for so long, because we've earned fees, this offsets the losses associated with leaving the range. So if you look carefully, even though were to leave that range, we're still in the green. We're still making some money. So as Rudy said, this is a 30-ish day option. It's pushing towards one side. We may be better off, or intern may be better off, realizing that gain. Again, no one went broke making money, even though the assumption was a bit wrong. We thought it was going to be stable. It went down, but recently we did collect fees all the way. So yeah, up to the right in fees. This helps us offset the risks. It's one of those where now starting moving forward, there's a 50-50 chance it's going to be in range or not, so might as well cut our losses. So I would recommend in turn to close this one, maybe redeploy delta neutral or bearish or bullish depending on their assumption. But for now, again, this is a trade that worked for us surprisingly. Even though it did move recently, we're making money. We're happy about this. And finally, ETH/USDC. It's another one. This one is the one that is a bit more dire. So again, price moving down. We have two positions open, both open within a week. And yeah, so maybe one thing that is, maybe it's a teaching moment. So we show these table rows, and there's a lot of information here. So in your case, is there anything that stands out or is not clear from these headings? Or yeah, maybe it's a good point to kind of maybe recap and see when you look at this row, what do you notice? Yeah, any questions about this, Rosalie?
Well, I don't have any questions because I think I kind of understand it well. But I mean, just looking at delta and effective spread, those are probably terms that not everyone might be familiar with.
Yes. So we show the payoff, and then you'll get used to it. But this is a straddle or strangle. This is delta neutral. You have green in the middle, red on both sides. So normally you want this delta to be close to zero as possible. Here, the deltas of both those are 71. So between 0 and 1, one thing that you should look at is the delta that tells you, is it neutral because I created neutral? Not quite. We'll see exactly on the P&L chart, but the first thing you should look at is the delta. And in that case, it might seem to say that it's working against us. Price went down, so knowing that it's a positive delta, meaning that you are it's getting worse and worse. This is a kind of negative convexity. It's gonna get worse, so might be something we look at. The other one is effective spread. So this one is also how much more fees you collect with that position, and it's above 1. It's 3.8% more than the fees, so that contributes to like this paying off more. So these two are two things you have to look at, and in that case, both of them I think probably have a similar length. That's why they're exposed in a similar way. But yeah, both of them have earned premium. Again, $20 in 2 days. They have some negative PNL, but that's really well compensated by the Streamia. So let's have a look a little bit more closely at this position.
So you're saying that because we know we made it delta neutral position, but the delta was 0.071, that should kind of like alarm us that something changed.
Yeah, a little bit. So the end state is either +1 or -1. And if we see here, it's going to be 1 when the price leaves that range. So now 1758 is when we're at 1. So this is kind of the place where we have to be worried because it's out of range, doing 100% kind of delta, meaning that you're only in ETH, and that's the worrisome part. Here we're somewhere in the middle, but even without looking at the chart, we started dead smack in the middle. It went down, so that 71 tells us it's kind of went down. But yeah, this is regardless of what we look at. Again, the price went down from 2,200 to 1,800, so $400. Again, 15%, 10% down in a few days. And despite that, the value of the position only went down from, I guess, 50 to 8. Yeah, so the price went down. We have half an ETH, but the price went down by $200, and we only lost 50-ish dollars, $55. Fees compensate for that. So the delta neutral meant we lost less than the move, but also fees compensate. We're right at the transition point, so it's actually like a wash, but it's like a good place to be because if the price goes down, we can recoup this, but it's earning fees all the time. So that position, even though it's a monthly, it's only 6 days in, it's not quite leaving. Price did see some pretty violent moves, and that's why it's out of range. But it's one of those where we're not overextended. We can certainly collect the fees because it's in range. So there's not an immediate reason to close this, but it's one of those that we keep an eye. If it does leave the range, then might be a good time to close. And yeah, so these two, one of them is earning a bit more. This is kind of the activity selling and buying on the same price. Oh yeah, we we're funding this. Intern is the only seller on that call strike, and a bunch of people are buying it, which is great. So we're in control. So we can, for exercise, we have a lot more say. The put side has not as much buying, but also other people in part of it. So yeah.
Interesting.
Yeah. Oh, I realized the music is still on. I know Brennan hates this. There we go. So again, when we manage these trades, it's good to look at all aspects. Being in range is a good indicator, but also delta. We couldn't go quickly to the other one, but this one has been opened earlier this week. Seems to be a very similar trade in terms of setup. And similarly, this one has been hit by the down price move, but the fees collected offset a lot of the risks. So plus 1.2%, negative 1.6%. You're kind of down by that much. So this is good. So maybe the last thing that we may want to do before like going to the options hour is that we talked about this. Is there one token or one specific instrument or token that you may be interested in trading besides Ticker Bitcoin, and ETH, and then you can maybe set up a trade there?
Yeah, well, I was looking at MakerDAO, but also I was kind of looking at just our markets in general. There's interesting eigen as well that kind of caught my attention. Um, yeah.
Yeah, so the IV is also one signal that you should look at when you trade an option. When you sell an option, the IV is ultimately how much you get paid, how much kind of returns you expect. This is very high, so I think let's actually have a quick look. So ETH IV is extremely high, 265 annualized, and I would suspect it's because one huge chunk of liquidity went. Oh yeah, one huge chunk of liquidity went out of range. So here you used to have, oh my god, 400 ETH worth of capital. Now you're down to 40, so 10x less liquidity, and trading is still happening. A lot of people are trading, so that's why you have this huge spike. So again, one of those well is a slip as a switch. I would be happy to buy that liquidity and relocate it for them, but that's why maybe IV is so high. It just went out of range, and trading is not kind of backstopping enough of this. So very juicy, driven by the Uniswap liquidity providers. Um, Same thing with BTC. But yeah, let's look at Eigen for a little bit. 100%, 96 is pretty juicy. This is one of those where it doesn't seem to be like because there's no liquidity or it's out of range. There is a decent amount, 10 ETH worth of liquidity, and there is some depositors, so you could trade and with leverage. And actually, let's go trade. Let's look at the price action. I'm not following Eigen price action too much, but it's been faring well. Yeah. This is the ratio, but given that price action, we don't do a lot of technical trading or chart gazing. But yeah, it's always good to have some idea of, given what you see here, what type of sentiment do you have for the Eigen ETH pair?
Um, I guess bearish or more neutral.
Okay. And ETH is going its own thing with price. Same thing with Eigen. The ratio is where we care about. And it's true, it's been going down, maybe more stable. Could go down, could go up, could be neutral. I also am partial to neutral trades, but you can also say, no, I think it's still going to go down. I don't believe in, yeah, or I do believe in Eigen. I think it's going to go up. So I would say that the correct entry point is yes, IV seems juicy. There's a lot of liquidity in Uniswap. We can trade on leverage. So why not create one of those neutral strategy actually? And then if we do this, we can choose the range. We can be exactly in the middle, and that would be a delta neutral. But because we have maybe some directionality, we can be offset a little bit, so that even though we're in range, we have some kind of negative deltas in that case, and we can make money if the price goes down. So even though this is a delta neutral trade by construction, changing where it's located with respect to the current price can transform it to a neutral to bullish trade or neutral to bearish trade. So that's kind of I would say strangles are more capital efficient. They can actually kind of double the capital efficiency in a way. So I would look at, maybe if you said a bit bearish, neutral to bearish would be that type of trade that I would recommend intern doing. You have some risk on both sides, of course, and we estimate the premium. But if the price goes, oh, it's very small denomination, hard to see. But if the price goes within plus or minus 25%, which is still a long way, then you're good. So maybe that's one trade that intern could look at. Eigen token restaking is huge. Again, I'm sure they have a lot of things in their in their arsenal, but is it enough to outcompete ETH? We'll see. But yeah, that is one cool trade on the Eigen market that you can do or do and access leverage. That's good. So yeah, and then this is it for now. So I think intern is doing great. And maybe last thing, we can look at the points tally. We revamped the interface a little bit, but now we can see um, a bit more closely points. But now intern is ranked 49 because they've been selling options, because they've been on that short liquidity side. Not just the deposit, but their activity means that they're earning points at a faster rate. 49th. I think I'm happy to say we dislodged Ethereum intern and passed them by. This one had a bunch of yeah, a bunch of boosts actually. So yeah, pinup intern is uh, doing the smart thing, which is selling options and doing it in a responsible manner. So that's why they're kind of inching away above the increasing the ranking here. So
Cool. Yeah, I think with recent price moves, it's probably a good time also to kind of reevaluate our interns' ETH positions and kind of figure out a new strategy to go with this sad market.
yeah, but yeah, I think, and then maybe back to the market moves. It's actually very worrisome. But if you're diversified in your strategies, and if you're not necessarily doing one thing only, but many things, in that case, the BTC ETH is earning some money. The ticker Bitcoin is earning some money. This offsets the losses in ETH USDC. So you as a trader has to kind of think about smaller trades on diversified instruments so that one will net one off. You are just harvesting fees regardless of which way. So we want to have the capital exposure to be neutralized, but have just a fee getting paid for you. So in that case, intern is getting paid $9 for their trouble. And then again, part of it is despite these huge moves. So very, very cool. Um, all right. So I think that's it for the stop trading, stop losing, start trading. We'll hand it off with Brendan, where we'll do the options hour. So, hey, how are you, Brendan?
Hey, great to be here. Crazy week, but yeah, it's nice seeing the intern trades.
Rosalie's masterful trades have made intern money, so that's the best outcome possible.
That's
Yeah,
great. A down week like this, yeah.
All right, thanks very much, Rosalie. See you next time. But yeah,
yeah.
Sweet. Well, it has been a crazy week indeed. Gonna pull up my window here, but as you see, we have a big jump in search on recessions, and it's been maybe post-COVID since the last time that has happened. So lots of talks with uncertainty, tariffs, and I think the China tariff on steel or something like that is going into effect today.
hey, wait. So what's that dotted line there?
Yes, this is the projected,
Oh,
or it's incomplete because we're not at March 15th yet. So I guess
so
maybe it
it's
means it can only go higher from here.
I see. So it's extrapolating because we're 3 days away, but we're almost there. I see. I thought it
Well,
was
maybe it's extrapolating. Yes.
yes. Okay. Recession. Very scary.
So lots of bad news coming out on the economic side. Lots of drops in the markets, the crypto markets. We have ETH, going down below 2,000. It hit 1,800 almost. BTC going down below 80,000, hitting 78,000 almost at one point. So lots of scary news, but thanks to options, we don't have to be directional necessarily, or we can profit off the bearish side. But that is kind of what we're currently in the midweek right now.
Is it going to go Is it going to be worse? You think? What's your medium term outlook?
Well, I don't know about the medium term because most of this is pricing in, potential worries of tariff uncertainty and potential recession. Trump was saying recessions are not off the table. Things are coming, big changes are coming, and so we have to be ready for anything. And so this very kind of a forewarning of potential problems. And so the market correcting ahead of time, I think, is telling us that we're pricing this in earlier. So really from here, it might be the time to take advantage of the situation. Not financial advice, but there is a lot of fear and uncertainty right now, and I'm kind of the mindset that this is a good time to start taking advantage when everyone's afraid.
Exactly. And again, we talk about the options market, but I've looked at there's a lot of put skew on the S&P 500 stocks and the Nasdaq. People are expecting some type of downward move. Most ETFs also have a put skew, but this one is pretty juicy now. Uh, with options, you can trade, but then also be directional. And again, the way that the risk direction is kind of meant by the how you trade options against. In that case, put skew is very, very much what we see.
Yes. A lot of friends are just buying and holding Nvidia and other stocks, and so they're down bad. But that's why I love these option trading sessions you have with Rosalie and others. It's great to be able to learn from. But we have a couple of questions from the community about various topics. So this options hour will focus on a couple of frequently asked questions that have been coming in about our points program, about how perpetual options work, and we have a couple of announcements. So we also wanted to cover the hyperliquid issue, I guess. So we'll get to that as well. So stay tuned. Please feel free to drop any questions you have in the YouTube chat if you're watching there, or on Twitter directly, and we can get to your questions there. But starting off with the first kind of well, I guess first announcement is by popular request, we have brought back our 2x pips boost. So this is the Panoptic incentive points that we are giving for people who passive LP, deposit, trade options in various markets on Panoptic on both Unichain and Ethereum. And so this is limited time only boost till Friday. So anyone who deposited in the last 2 weeks or so, from when Grow came out till next Friday, is going to earn this special points boost so that you can earn extra points on Panoptic. So make sure not to miss this. If you haven't deposited recently, deposit in one of our Shiny Pips pools and you'll get this 2x bonus. So we did have a question about how the pips work. So here is our, well, first of all, I'll go to our leaderboard. So if you go to app.panoptic.xyz/leaderboard, you'll be able to see the rankings of everybody and how many points, we call them pips on Panoptic people have earned. And there was a question just about the difference between the base points versus the boosted points here. So yeah, do you want to explain what the difference is between base and boosted points?
Yeah. So the way that this is when people get a boost, you get this for depositing to Grow Platform 2x, but also if you're a Uniswap LP on V3, you get 5x boost. On V2 is I think 2.5x, but it's increasing the rate at which you earn points and pips, and we still take the basal rate and we kind of bonify this with the boost. The boost is done in a way that's very physics like and over engineered maybe, but it's a decaying boost. We see this where you earn 5x and then you end up with a larger balance, but the 5x is not for the forever. At some point this boost is decreasing, so we also I think show it on people's balances, but it is just kind of tracking what your normal returns would be with the base level, but the boost one is what is included with that extra points. And I think Ethereum in turn, just right now I showed, has a decent amount of base points, but then because they had a big boost, they are over 1 million. So yeah, next one I think that's, yeah, so that might be the 10x there, but yeah, 144,000 base. They did the and yeah, in Twitter term, they know the best protocols. They did the beta for Panoptic, maybe with UniV3 and V2 LPs, maybe Pro app users, and they can pile up these boosts there.
Yeah, and can you explain a little bit about the rationale of why these boosts do decay, and how much can you expect then these boosts to actually give over time?
Yeah. So the formula is you have to integrate over e to the x or e minus x. If you've taken calculus, should be easy for you. The key point is that a boost of 2x means that you earn an extra 200k pips over the lifetime of your position. And so you earn a boost or you earn a bonus, but you have to work for it in a way. So you cannot get this distributed to your account right away. You have to PLP for a bit or maybe trade for a bit, and that just makes it more rapid accumulation rate, but it's still gonna taper off. So yes, if you can zoom in closely to that chart, the initial 0 pips or 0 bonus is a straight line. depending on your boost, you have a higher rate at the beginning, and then it ends up giving you a higher number of boosted points towards the long term.
Yeah, I like this heuristic here. You have where you subtract 1 to your boost and times it by 100,000. And so if you're getting this special 2x boost, for example, that's going on right now for depositors, kind of translates to 100,000 extra points pretty quickly, I think, in my experience. So that's kind of the potential extra points you'd be getting from depositing here. Thanks for covering that. We also have let's see, we have in the market kind of roundup for this week. We talked about kind of the big crashes and price and tariff concerns leading into the market's uncertainty. I was looking at the ETH market, so specifically the wrapped ETH USDC market on Ethereum, and then also the wrapped ETH USDC market on Unichain. And the common denominator on both these markets here is a gigantic IV. We're seeing IVs over 100%, as high as 265% on this pool. So yes,
Can you go to the Unichain one? So I think we covered the Uniswap liquidity was just badly deployed on mainnet. I'm interested. Can you hit the Uniswap tab there to see?
Yeah, there's a bug on this one.
Okay.
But on mainnet one, we can see.
Yes. Let me do this. Yeah, so this is kind of the part of this is a daily average. So lots of trading, lots of activity. Now you go to a lower amount of liquidity, then there's more impact. So this is where the pip. So any unit of liquidity works a lot longer if you have no other people to compete with the same trading activity than if there's a huge whale doing kind of liquidity provisioning. So yeah. Very cool.
So yeah, I mean, this IV is a little bit differently calculated differently than the traditional IV. It relates to the higher the IV, I guess the lower the liquidity, right? Here there's not very much liquidity compared to here. The higher the IV, and also the higher the volume, swap volume going through Uniswap, the higher this IV. And so I think you're saying probably a big component of this is actually the low amount of liquidity in Uniswap and this inefficiency of moving liquidity.
Yes. Again, I'd like to be buying these millions of dollars worth of options. So whoever is managing this, think about Panoptic. You can earn more because people will buy, but also be able to kind of take directional bets as well. So that's very, very interesting.
Yes. So, but with these high IVs here, would you still be buying at this strike at this?
No,
current
I would buy the out of range liquidity. Whoever is not managing the liquidity quickly enough could mean that you could buy. So this is Unichain. Oh no, if you go to Unichain, I'm trying to you go down a little bit to the options chain. So again, what we look for is in the money, out of the money. So you have some options above the line, some options below the line. And what you want to see is the delta row. So the column. So most of those have deltas between -1 and 1. But if we were to scroll down, I'm sure there's going to be some delta of 1 or delta of 0 on the left-hand side. So these options are effectively not even in play. And this could mean that you could buy them in a way that is free. So if that means you can actually relocate someone's liquidity. You can say if you hit the buy, it's going to set up a trade, but you can sell another one to offset it. But yeah, a lot of what we're seeing is that even on mainnet, but it seems also on Unichain, sometimes it's hard to respond and it's not something that you can do 24/7. But I would say that if you trust the retail or professional retail users to help you with liquidity provisioning, you can trust that they will move it for you and be in range. So it just helps, not because we want to buy or short someone else's liquidity, but we want to relocate it to be more efficient. Is kind of where the advantage of using Panoptic is.
Yeah, and I'm actually on the other side of this. I'm one of these inefficient people over here. I think I put in I sold some options up when ETH was a bit higher priced, and now I'm sad that the price is way down here, and I just want it to go back. But what should I do? Should I
No,
close
exactly.
out
So
that position?
without doxing yourself, go down to the options chain. Let's look at one of those 100 delta puts. So on the, I don't know if it's a put, go down to like 2500 ish. Yes, if you click on any of those, click on the strike, click on that chart on the bottom left. So you'll see. So this is, yeah, click on that chart. This is a problem. Whether it's on Uniswap or options trading or anything, you look at the P&L chart and it's bad, right? So if you click on the tooltip, we'll see what the range is, but it's out of range and it's losing. And you say, no, I don't want to. If you close that position, that impermanent loss becomes permanent. And that might be, hey, I don't want to realize that $25 loss. Maybe I want it to go to bounce back. And that's perfectly fine. This is kind of the gut reaction. I want to hold to make sure that maybe it comes back. However, you are doing this for free. You're out of range. Your fee accumulation rate, and if you're on the Premium tab, it's stable, at least not moving much. And that is kind of the problem. You, of course, want to capitalize on the price reversal, but if you're doing it for free or if you're not getting paid, and I don't know the break-even point, but if you don't think it's going to go up another 10% in the next week, then you're better off eating that loss. It's unfortunate you've lost less had you buy the token itself. You've lost less than if you were trading on a perp. You have this kind of getting paid as well. So it's overall a bad trade, but you should move on, redeploy in range, get paid. If now you are extremely bullish, you can still change the location, but being in range, getting paid for that, getting that theta flow is what you should be focusing on. So you, Brendan, anyone is listening, yes, it sucks. It's a bad trade that went against you, but it don't make it worse by not getting paid for that extra risk.
Yeah, I think it's very much a mindset thing. The dead weight loss, it already happened, but how you respond to it is.
And the way you close this as well. I mean, if you the reason why you sell a put is, yes, you're directional, yes, you want to get the price up, but effectively the put gives you the right to buy ETH at that strike. So even though you say, oh, I don't want to eat that loss, I'd rather have ETH, it's fine. That ETH will be your collateral. It will be part of your balance. And on the close tab, there's a cover, like the cover at burn or kind of zap. So you can still effectively close that trade, buy the ETH. This is going to be part of your collateral. Maybe it's going to earn a different yield. Maybe ETH is higher than USDC. So you have kind of this new path forward where, yes, it sucks, you lose, but instead of losing cash right away, you are buying it at a slightly higher price, but then now it's part of your collateral. You can sell calls, you can do a lot more with it. And that's another way to effectively, and it's a silly and hard to pull off strategy, but it's called the wheel in TradFi, where you sell puts, you get a sign, you sell calls against it. If you get calls against it in the sign, you have cash back, so you can go round and round. It's still a positive delta strategy that won't work in downturns, but it's one where you effectively assume the risk of, okay, I'm buying the asset, now I can sell a call against it, type of thing.
Very interesting. I think we'll have to have another session to understand the wheel better, but very cool. Okay.
There's Theta Gang, or there's a bunch of subreddits about the wheel. It's it's like the covered call vaults on Ribbon. Like, it works till it doesn't, and there's no escape route. If it goes down, you get exposed. So I'd rather do I don't know if there's a wheel for delta neutral, but yeah, something that gives you a bit more protection inherently built in.
All right. Well, thanks for covering the markets with us and these high IV opportunities and plenty of free options sitting out there for people to purchase. Any other comments on the markets before we move on to the next question?
Markets suck these days, but don't despair. There's always a trade.
Yes, whatever direction it goes, there's something you can do with options. Right? Well, let us move on to the announcement, I guess. Second announcement here. We are running a debank campaign. And so if you're worried about participating in these markets and being like me with this short put or out of range options, you can participate without any type of direct exposure to the delta gamma price risks of these positions. So we're running a campaign on debank, and it's really simple. All you have to do is deposit USDC onto Panoptic. So it's as simple as that. You go to this market here that we were featuring earlier. It's the one on Ethereum mainnet. It has this shiny sparkle on it. It's the ETH USDC 30 bips market. And on there, if you deposit USDC, you do have to approve and then deposit. So always 2 steps in DeFi. But if you deposit USDC on there, you qualify for 1, you're getting this 2x boost that is till Friday. 2, you're getting extra points for just leaving your capital in Panoptic every day. And 3, you enter to win this prize that we have. So 5 special lucky cash drawings of $100 each to random participants. And so you have a really good chance here, higher than around just under 5% chance is like a pretty high chance here of being able to win this. So check out the debank campaign. I'll make sure to post this in the chat here on Twitter. But check it out, and if you haven't deposited already, you can do that, and it's a really easy way to kind of dip your foot in to the Panoptic ecosystem. Super easy, no impermanent loss, and you're lending out your capital to the Panoptic and Uniswap ecosystem so people can LP on margin. So it's a great way to get in to this. Yes, so if no other things about the announcement, we'll move on to a question from a Discord user that we had. And I'm going to bring it up here on the screen. I thought it was a very interesting one. So somebody asked about the whole perpetual options thing. Panoptic is built on the thesis that LP equals options. But as we know, options have this type of expiry date. Options expire in 1 day, 1 week, 1 month, etc. So how is it that we can take like a non-expiring Uniswap LP position and relate it to a like expiry or time scale on app.panoptic.xyz? Like, what does a 1 week or 1 month option mean? And I think I'd love to just hear your thoughts in general on kind of this relationship between LP positions and expiries. And I have your Medium article pulled up as well, if you'd like to reference kind of the specific formula.
Greatest hits. If you go back up a little bit, it's very, very visual and mathematical. The payoff of a Uniswap LP position when it's in range, like it's wide, has some level of, I don't know if I can take note, but yeah, has some level of shape to it. What we do is simply trying to get that shape into a similar status as Black-Scholes, which is the options pricing model for like most assets. And yeah, the extremely naive way of doing this is, can we make Black-Scholes payoff for a covered call look as close as possible to the Uniswap LP payoff for some positions in some range? And again, if you're above the range, you're 100% USDC, below 100% ETH, so you have this kind of transition. So it's as simple as kind of doing some geometrical analogies, and the middle one shows the two superimposed with one another, but you kind of estimate from Black-Scholes at some days of expiry, some IV, what the corresponding payoff curve would be on Uniswap. And at the end of the day, it's one way to look at it, very, very graphical, mathematical. How do you make two instruments close together? and then you now say, okay, this is an LP position that's 25% wide. That corresponds to a 50% IV, 27 days type of option. And that's kind of the best way to think about that. And at the end of the day, if you go to a Uniswap position, it has a range. Maybe you start in the middle, maybe you start offset, but another way is to think about the math of it. All price action is random, goes up or down, hard to predict. Some days goes up, down, but you can not know which direction, but you know how much volatility there is, how much price movement are you expected to get. And that's maybe a slightly different way, but given a range, plus or minus 25%, plus or minus 50%, plus or minus 200%. So from 2x to, I don't know, 0.5x, you have some math that can guide you through and say, all right, given the volatility of this, what's the likelihood it'll be in range? And you use typically one standard deviation at 68% of the time. And that's another way to compute the effective time scale given an IV or a position size. So both of those rely on the assumption that prices are moving randomly. Black-Scholes uses this to create a very direct payoff curve, or you can be a bit more close to fundamentals and say how wide are you given the initial position, what's likely to be in range, and that's another way to tie volatility and timescale.
So is there an assumption on the volatility of the underlying when you're formulating this comparison between the expiry and the LP positions width?
Yeah, so as it is, not really. And then I've made a deliberate choice of putting T on its own on the left hand side for the top one. But the real quantity that matters in options trading is sigma root T or sigma squared T. And this is what you see here. Sigma, the volatility, and the time scale are kind of linked with one another. And again, I don't want to do one lecture, but in physics, you have this thing about scale invariance. And if you can rescale everything so that it's dimensionless, in that case, volatility times square root of time is dimensionless quantity. That's why you can kind of do the math with it, because you are kind of neutralizing all the units. And that sigma root T is what we use to some extent to attach a time scale given a volatility. But that formula where it's sigma squared T on the left and 2 pi everything on the right is going to be like holding up for any time in volatility assumption. So and sigma root T is what you put into Black-Scholes. You can scale everything by time, by IV. S&P 500 has a low IV. Tesla stocks has a super high IV. In that case, you still have two competing forces, but you can rescale everything and get one answer, if that makes sense. So yeah, this is going on a tangent, but the key point is that when we do this, sigma root T is the quantity we have to kind of keep constant. And on the UI, we assume sigma is 50%. And we solve, given that 50%, what would be the T that would neutralize this. And that's why we get the 1 week, 1 day, 1 month, 1 hour, 1 year. It's that sigma is fixed at 50%. Sigma root T has to equal the square root of R, which is kind of the Uniswap specific properties, how wide it is, and then this is how we can extract the timescale.
Yeah, I liked your table example down here. I think it uses maybe a different volatility of 100% than the UI, but it's really easy to understand how the expiry date on like a 1 day or a 1 week or 3 week option translates to. This is a plus or minus 9% width in the LP position, or a plus or minus 25% width, or a plus or minus 47% width. So this is just kind of plugging in the number 100 for the volatility, and then the number 17 or 21 for the T here, and then this outputs your kind of your width of the LP position, and that's what you're seeing in Panoptic when you're trading 1 week, 1 month, 1 day options. You're seeing a wider or a more narrow position.
That's correct. So again, the Eigen market we looked earlier had 100% IV. The ETUSDC hovers between 50 and maybe 75%, 80%. So we are kind of overestimating the time scale a little bit. We'll have to figure out if that's a good thing or a bad thing. but we make it upfront. 50% IV is what we have as the benchmark. So, but yeah, that means the fees collected on a 1 month timescale will be similar to a upfront premium would get paid for 50% IV at the money option. So yeah, it all is rooted in the world of options. We are hard coding to some extent the width so that it's a bit standard across all different pairs. But yeah, that's kind of the way we approach this.
Yeah, I thought it was interesting when I was checking out the IVs earlier today. As you saw, the IVs on ETH USDC were over 100. But I think for the Bitcoin ETH one, it was a lot lower, something like 50 or something like that. So, there's these more correlated pairs, and yeah, they're a bit, they behave differently. So
Yeah, definitely, and that correlation is meaning that the IV relationship between one and the two is very small, and in that case, the IV used to be very small, something like 15-20% in a way when it was not very actively traded. But yeah, the you assume USDC is your base asset, so it has a little bit more volatility than the ETH one. So yeah, a lot of that IV, we did a lot of research. We'll continue doing this, but this IV is kind of the name of the game. You have to understand what IV means. You have to understand how that IV, again, IV rank or percentile compares to itself. And that should be your entry point. Even though it seems like 45% is low for ETH BTC, it's on the upper end of the scale, 84% percentile for that trade. So it is, regardless of the absolute number, on the higher end. And I'm looking at ETH USDC 5 bips, which is different than the 30 bips we have. And this one also has a high IV of 140%. So it is kind of the current environment is definitely favoring option sellers because of that inflated IV.
yeah, that's a super helpful tool to have, that IV percentile or rank, because as you mentioned, yeah, you can't really compare these and say, oh, this one is really low, this one's really high, but it's more like a comparison to itself, right?
Yes, exactly. And then if you're doing it properly, you have limited capital exposure, so you're delta neutral with all your trades. So you are okay with a price move of plus or minus 10%, for instance. It's not going to eat away at your profits, but the fees you get paid is what is important. So you want to be short term able to survive the price move by being delta neutral on the setup of the option, and at the same time we want to capitalize on high IVs. And again, that's why even with Rosalie, the portfolio is 15, 20, 25% utilized, so there's room to expand, and you can create a neutral or directional one, but you want to be able to capitalize on these moves. So typically most of them it's sit back, make sure you don't get wiped out when there's a big crash, but when that crash happens, then you can capitalize and double down in a way. And then typically historically huge crashes are followed by a few days of quieter markets. Could be a 2 day, 2 weeks type of trade, and you exit and are happy to make money. Could still go down another time, but at least you're able to capitalize on that immediately afterwards.
Wonderful. Well, we have just a couple minutes left on the stream, and I think the topic for the options hour was about Hyperliquid. So let's hear about what is the latest there with the whole liquidations and the vault.
Yeah, I mean, I'm crypto Twitter first thing in the morning. People were worried about Hyperliquid, saying, "Oh my God, is there a hack?" Because you can see their PLP vault is having people deposit, people market make, the Hyperliquid market makes, and they are kind of the ones taking the risks of kind of trading a little bit. And in that case, there was a huge drop. And maybe it's worth sharing my screen, one of those tweets, but people woke up and saw a huge drop in the value of that pool. And here there's different kind of, again, high TVL, different type of trades, but that immediate drop was what people were worried about. It turns out it was mostly a trader getting liquidated. That trader had, again, I think $200 million worth of ETH, which was pretty high. And then this is TVL, but yeah. And that created some level of response from the markets. The one thing that is kind of interesting is that the liquidation mechanism, or how it works, is that the liquidator now is in possession of the distressed assets. So someone had, I think, a long ETH position. price went down, they normally would get liquidated if they don't have enough collateral. So they had plenty, but they withdrew the collateral, left the position easy to liquidate. But the liquidation process meant that the liquidator would take control of these distressed assets, which is long ETH. And normally the hyperliquid vault is neutral or cash based. So they have a lot of liabilities on their balance sheet, and they are exposed to price moves now in a way that they weren't before. So any gains they do on the market making side is only USDC based. But now, because of that, when they see the price of ETH going down, they are exposed to some level of downturn. So that is not necessarily a good position for the hyperliquid team. I haven't kept up this morning how they respond to that, but people kind of initially were worried. They were able to rationalize what was the the outcome of that. I think the key point is that even if you're a passive liquidity provider, you could lose money even if you trust someone to do it properly. Downward moves, large price moves could still eat away at your profits. So the PLP was meant to be passive liquidity provisioning for hyperliquid. Market downturns mean you may be losing your capital. So that's market conditions doing, and I'm sure hyperliquid worked exactly the way it should. It's just the process of liquidation added a lot of risky asset on that vault's balance sheet. And I think this is TVL. People are withdrawing in kind of maybe being scared a little bit of the possible losses given to that. So yeah, lots of interesting takes on Twitter for sure. It's not something that the average user is typically worried about. But if you are at risk of getting liquidated in your own account, you're also at risk of getting liquidated on the PLP Vault type of account. So, but yeah, I mean, it's I don't think it's worrisome. It's just what did losses get socialized in a way, and now everyone in the PLP Vault has to manage that extra exposure. If the price were to crash another 10-15%, then that could spell trouble for the HLP Vault.
Yeah. So do the vault participants know, like, do you think they know about these types of exposures when they're participating?
I don't know. They should for sure. And again, with the a lot of the risk is trying to be passive with none of the risks, right? Risk reward, there's always a spectrum. And if it does look like it's too good to be true, it might be. But then if there's a huge price drop and you have no exposure, no way to control it, the risks are there. And then that's really, again, always interesting takes. But it's like you can be active and you can seem like it's going up always, but it's like the lifetime of a turkey. It goes well until it doesn't. The key point is that even if you're active, you're passive, you're active in an active market. So of course they had months and months and months of positive trades that meant they had good P&L. The one can wipe out a few months of worth profit and they still high, but it's just the fact that you're balancing what is extremely risky on the inside has to be reflected on what's the PLP, the passive liquidity providers, are exposed to as well.
So Millie mentions the passive LPing kind of in a, I don't know if it's derogatory, but in a, there's some risks here that aren't maybe fully understood potentially in the HLP vault. And I'm sure, they probably just like show these risks and stuff, but I'm not sure if everyone understands it. But when it comes to passive LPing on Panoptic, then the PLP grow that we have, how is that different? Do we have these types of exposure risks?
Yeah. Again, the risk-free rate, which is staking or bonds, it's either the Ethereum network collapsing upon itself, not just the price, but the actual like way it works. That means your yield will go to zero, or the bonds market, the whole country going down, or in a way that is irreparable, means you lose that. But if you trust on the long-term stability of a country or the long-term stability of Ethereum network that contains hundreds of thousands of validators, this is the risk-free rate. You should expect nothing below that for any activity because the risk-free rate is going to be what the baseline is. In that case, we are on Panoptic lending to market makers the yields are higher than lending on Aave and Compound and Morpho and Order because it is more risky. You have more upside for the market maker, but more downside. So the risks for a PLP is similar to the risk for a hyperliquid liquidity provider. Big liquidations, market wide kind of collapse, some distress account don't get liquidated in time, there's loss that's realized. This is where you lose. So even though you earn 10-15% APY for 364 days of the year, there could be one day at the end that you lose 9%. So or whatever, something that brings it back to something more accurate. So you would expect the rates to be higher, the risks to be higher as well. And it's kind of name of the game. You cannot escape. You cannot have risk-free trading with non-risk-free rates. And maybe that's have pet peeves of mine is the AI agents, the trading that will do all the trading for you. They will find the best trades. You will earn 45% APY because the robot, the AI, is much smarter than you. At some point, you're fighting against a extremely complex trade, an extremely complex market, and the risk will still be there. Even though you're the smartest AI around, there's going to be risks. Risk reward is just going to balance out. And you play the wheel of time for a million years. Efficient market theory tells you that the risk-free rate is the only thing you can get, whether you're doing junk bonds or extremely active LPing or options trading or extremely wild perp trading. You play this game for long enough time, you will be net at the risk-free rate. It may seem gloomy, but the key point is that if you can capitalize on these events, you can go in and out, you don't do the same strategy kind of in a way that is totally random, then you can get ahead and then risk off for a while, get a risk-free rate. If it's time to risk on, large crash, all the world only ends once, then you can capitalize on it, then you can edge out. So any automatic redeploying like sustainable strategy will earn the risk-free rate, but it's kind of positioning and sizing is what gets you ahead.
Yes. So it sounds like, there is some risk to lending out your assets in a big downturn and a liquidation that isn't caught. So is the risk here kind of intrinsically linked with how good the liquidation system is and like the buffers there? Like I'm not sure if I understand the whole how the liquidation wasn't caught earlier on Hyperliquid, but
yeah, for them, we at least at Panoptic, we don't allow people to leave their positions exposed to liquidation risk when they withdraw collateral. So we allow a buffer of 33%. So you are at most 75% buying power utilization when you withdraw. That gives you some buffer zone and that gives you some room to play in terms of, yes, you remove capital, but you won't get liquidated right away. I'm not sure how Hyperliquid does, and again, me requires some digging, but that's one way that we prevent some of these people running away from their responsibilities and withdraw their cash. That maybe is what the Hyperliquid team did. And at the same time, that would be maybe one way that we could be differentiated. You cannot leave an option a portfolio liquidatable after withdrawing.
yes, and so that's interesting. Thanks for covering the Hyperliquid situation. It's really interesting to see the whole passive LP debate that is now sparking. I think those words weren't even the popular conception.
A bit of alpha. We're creating what looks like options vault, or we're creating something that is maybe on the HLP side, where we can have your capital be traded with and getting some exposure, but it's also inherently with some risks, and also the long-term outcome might be not as good as you think. But the key point is that if you can position still within these passive strategies, kind of reallocate, it is also another way to get ahead.
And I mean the whole liquidation side, we have a liquidation monitoring bot as well to catch these positions before they hit an extra 33% buffer, right? And so that's kind of the you can take it into your own hands if you're concerned, right? You can be the liquidator, you can get the liquidation bonus, but
yeah,
such as
that's right.
Passive.
Exactly. So even with the price moves, we haven't seen that many liquidations, meaning that people are doing it right. They are a bit more conservative. They don't put all of their kind of capital at risk. And again, these 10-15% price moves is not causing systemic risk, which is not what you see in perp protocols, because you can go 100x and very quickly get the whole thing liquidated, because we're trading with options that are weekly, monthly, even daily options. They have some resiliency to these price moves.
Yeah, I mean,
But
have
yeah,
we seen even any liquidations in the past week?
I don't think so. We can look. We have an internal dashboard. We can actually. Is there anyone? What do you think? Is there someone?
I haven't heard any. So.
Yeah, there's one. Yeah, no one is liquidated or liquidatable, which is congrats to everyone. You are trading right. You want to survive. You don't want to be cut where you get liquidated, lose your capital, stay salty about it for decades. You have to manage. Survival is the best way to be successful. The longer you survive, the more you put the odds in your favor, the more you can accumulate these successful trades, the more you learn, the more you can actually be successful long term.
Well, props. Maybe thanks to some of the education that Guillaume has been teaching the intern recently, keeping people trading safely. So
Intern will out trade us all very soon. But yes, this is good. Thanks. I have to hop, but yeah, thanks a lot. This is a great trading show, a great options hours too. But yeah, we'll log off. But yeah,
we'll see you on the next one.
see you next one, Friday. Best trades of the week, and also another stop losing